So there are two components in wealth building, and everybody talks about how to generate wealth, but nobody talks about how to mitigate risk and liabilities. So hi, I'm Jacqueline. I am a retired CPA that has been working with very wealthy people my entire life in Fortune 25 companies, and I have learned a lot of different things that I guess I realized most people don't know. So let's talk about why we want to focus on protecting your wealth rather than just making your wealth, right? Because these are the two components. So everyone talks about making it, right? How to hustle, how to get more money, how to grind, how to create a new business, how to do what you got to do. But no one talks about the protection side. So protecting is super important because there's always going to be events in your life. There's always going to be risks in your life. Life is always going to throw you curveballs that you're never really quite ready for. I see this all the time in my business. People get sued. They're going through a divorce. They were running a Ponzi scheme and going to prison, getting walked off in handcuffs with the FBI. I see all of this. They lose a lot of their wealth to taxes, for example. That is another one. So when we're looking at all of these things, we want to look at different types of things that will affect your wealth and how you mitigate it. So I always tell people, wealthy people, once you hit a certain point, you care less about making more and you care more about preserving and protecting it. So you go into safer investments, you go into lower risk because you don't really care. You don't need to amplify it like you did when you were growing your wealth. So the wealth making, you're talking about how do you get the biggest return on your investment? Protecting is how do you take the risk away? So we see this a lot through insurance and different types of strategies. So let's talk about what we do. So let's talk about tax deductible investments. How do you mitigate yourself from liability and risk with these? So anytime we have a client who's going to make an investment, we always want to set it up the same way. And why do we want to set it up this way? Because one, it prevents commingling. It prevents you from putting money in without getting the money back out. And it prevents anybody being able to come after you. So the key being, anytime you form a company, you want that company to be self-sufficient, self-reliant, and if you can't, you're going to use a loan, okay? So we're going to have this little buddy create an LLC. And this LLC is going to now, most of the time we just do single member, or even if you're married, it doesn't matter, you're married, it's communal property most of the time. Consult your attorney on that, but typically we do single member LLCs. For the tax purposes, you're a qualified joint venture, so it doesn't matter. And then you're gonna loan the money in so that when you make money, you can get the money back out and there's no commingling. You can take that money whenever you want, however you want. You set the loan terms as long as there's third-party interest rate and you pay the interest annually. Nobody cares. Interest is taxed at a much lower rate on your 1040. It's in the investment column, so we can offset it. So what I always tell people is you want to put the investment in to the LLC. So we're going to put our little money. Money comes in. So we're going to have money, and money is going to convert into investment. Investment can be anything that's tax deductible. It could be oil and gas. It could be real estate, 401ks. Whatever you want that we got to do to get you where you need to be. So I always use loans because you want to be able to get that money back out. And if you need money, you want to be able to pull from all these different avenues. A loan is a liability on your balance sheet. To the company. So if you have a liability in here, and you're not making money, no one's going to want to sue you because there's nothing there. You can't get blood from a turnip. This is how you avoid commingling. You manage it through the loan process. If you don't put a loan in, I promise you your CPA is going to make it a capital contribution. That capital contribution is an asset. It goes into your equity. So you have equity in here for yourself. And in the LLC, you're getting an asset, which is cash. So these are all different characterizations and things that you need to think about and things that you need to be aware of. Because if you commingle, meaning you pay the bills for the LLC with your personal account and you don't have a loan, or the company pays your personal expenses, like your mortgage in the LLC, that's commingling, and now you pierce the corporate veil and they can come and sue you and take the investment and cancel that loan. So you have to keep your books and records very carefully and tight when you're doing this, because if you pierce the corporate veil, AKA commingling. If you don't know that, go and chat GPT it like everybody else. I'm sure it'll teach you everything. And that is what's gonna cause the problems in the legal space. And this is how 99% of the time my clients lose their shirts in lawsuits. They lose their shirts in every avenue, and it just doesn't pay off. So we always wanna put the LLC, whatever is gonna generate you income, we wanna put a line between you and that LLC. And so that's why we set it up in a business LLC. Like rental properties, if someone slips and falls, they could sue you. And the most they can take you for is what's in that business. If you have a house that's paid for in cash in that LLC, you are gonna get sued by an ambulance chaser that tripped and fell on accident, but it wasn't an accident. If you have oil and gas, you want to shelter the risk and liability in case the rig blows up or whatever happens. Things happen that we don't control. Lord knows I've had plenty of contractors that I know in my lifetime that were doing large developments, had a gas line open, guy lit a cigarette, and the whole building blew up. So these are real life cases that I have experienced. I've seen pretty much everything, I think. So we always want to put these things in LLCs and protect your personal space. This is why ultra wealthy people don't own much in their own name. They have their cars in LLCs, they have everything in LLCs. So this is how we manage our tax deductible investments. Especially if you're super rich and your 16-year-old is driving around in a car in your title, don't do it. Just don't do it. Someone's gonna literally cut your kid off and he's gonna rear end them, and then they're gonna get hurt and whiplash and they're gonna come after you. It's not gonna be pretty. Don't do it. So I always tell people you wanna shelter yourself, and this is how we do it. So in the super wealthy space, we use LLCs, whether it's tax deductible investments and different things for different reasons. The other cool thing is divorce protection. Most people are like, oh, I got screwed in my divorce. It's so expensive, la, la, la. How do you protect yourself in a divorce? I got divorced and I owed him $8,500 because I was nice and paid his legal fees, not for any other reason. But I had a trust in place. So if you do this before, remember all the planning has to happen before the event. So protection, I'm gonna put this up here in red. Anything you're doing in protection, you wanna do before. Before you're gonna do what you're gonna do. So before you get married, event, you wanna call an attorney. Before you buy the investment, you wanna set up the LLC, call an attorney. Like 1-800, there's a reason they say your most important advisors are your CPA and your attorney. This is why. So before I got married, I called my attorney. I said, hey, I don't want any of this stuff to get taken away in a divorce because I'm 50-50 on this marriage. She said, no problem. Jacqueline, big smiley face. I'm getting an insurance policy that I'm gonna leave the marriage with what I came in with, okay? She set up what's called a separate property trust. Okay, separate property. That means it is premarital, separate. It is not part of the estate. It is not part of the marriage. It is not part of community property, because you can be married in some states and not even be married, common law marriages. So all of these things you need to think about when you're moving in with somebody and cohabitating. Gen Zers particularly, because y'all love to cohabitate because it's expensive, and I get it. So all this is a reassignment. Reassign. You're setting up a property trust, separate property trust, so you're gonna reassign your assets. So your house is gonna go in that name, your 401ks that are old employer 401ks, anything that is standalone, separate, not current. This is why before I got married, I switched jobs, so everything was cut off. And anything and everything that he could have gotten was gone. So I put everything in a separate property trust. This is a revocable living trust. You can have it depending on your net worth, depending on how much money you have, depending on family dynamics, this and that. You can make it, when you die, convert to irrevocable. This is super important if you have little kids. Your little kids, you don't want them to get the money because they're going to piss it down the drain. I had some friends in college, parent died, they inherited hundreds of thousands of dollars, they traveled the world, they pissed it all down the drain, and they were broke with no education, and they're losers now. So don't do that. You want to set your kids up for success, which means you let them starve at a young age because they have no dependents, ideally, hopefully. And you want them to learn how to manage money before you give it to them. So my trust will convert into irrevocable trust for each of the beneficiaries. There are stipulations and rules that they can use the money. So education, they can use it for medical, and they can use it for buying a house once they're 35. Until then, they don't get to touch it. It's just gonna grow because compounding interest, duh. So when I set this up, when I went to get divorced, my ex was like, oh, I'm gonna get like $550,000. I was 29, I was a millionaire. So I was like, what the hell, this guy is crazy. And my attorney's like, don't say a word, get all the way through mediation. And then 2 sessions before you're gonna sign everything, you drop it on the attorney so everything goes away, and his $550,000 goes to, he actually owes you because you're gonna put claims against the property, the community. So if you do this right, and you set yourself up right, you can escape, or at least leave with what you came in with. And this is all that you can do. But depending on certain states, depending on how you do it, you don't need a prenup for this, guys. This is like, they don't even need to agree to it. I set mine up a month before I got married, and he was livid, and I was happy. So yeah, that's how you protect yourself from a divorce. And then let's talk about lawsuits, divorce, bankruptcy, prison. Anytime you know this is gonna happen and you're like, I don't have time, I just need to I've got 3 weeks to get this done. If you're going through a divorce, it's a little bit too late. You can't set this up. You're already married. It's already community property. But if you're going through and you have a lot of assets, we want to make sure that you're protected. So what would we do for our clients? So let's play this through. We got little sad face guy. Why is he sad? Let's just pretend he's getting sued. He got a demand notice. Everybody knows the demand notice is the start to a lawsuit, right? This is the beginning of it. This is the formal notification that you are pissed off and gonna sue them. And you're gonna sue them for X, Y, and Z, and here's your request. And sometimes you get it, sometimes you don't. So let's assume our little buddy down here, I'm gonna put this in green because it's money. Let's assume he has $10 million in cash. Our little buddy, he's got a little bag of cash, okay? And he's like, oh shoot, I'm gonna get sued. And my attorney told me it is not looking good. It's 50-50. I do not wanna lose this. Or even better, I'm getting sued and I know I'm running a Ponzi scheme and I'm gonna go to jail, because that happens. I've seen plenty of people go off in handcuffs with the FBI. Yeah, we'll leave it there. So what are you gonna do? There's a couple of ways that we can protect this in a manner where it cannot get taken into account for lawsuits, divorce, bankruptcy. If you're going to prison, it will protect it from going against repaying anybody that you hurt in the process of whatever you're going to prison for. I don't know. Murder, whatever. Usually you have to pay these people. So if you want to look like you're broke but not be broke, this is what we do. We buy our clients a life insurance policy. So we convert the bag into a formal bag, which is called life insurance policy. The life insurance policy has a cash surrender value. Okay, so we love these because there's cash surrender. What does that mean? That means you can live off of this policy until the day you die. But there's provisions and rules and things in the place where this can't go against tax debts, this can't go against lawsuits, divorce, bankruptcies. There's a whole bunch of things. These are pretty much isolated. So if you know you're gonna go to prison, you got $10 million, you don't wanna pay the people, you buy a life insurance policy before it becomes a lawsuit. Before you put the money in, it's no longer in there. And now you can give an attorney a power of attorney, and your attorney can pay your family out of the cash surrender value. If you have an existing life insurance policy, it's super fast. You just dump a bunch of money and you max out what you can max out, and you put as much away as you can, and that is what it is. You do what you do. And until you are formally notified underneath the court that you owe somebody, you can keep paying your premiums, you can keep flooding. So as the years drag on, then it becomes just kicking the can down the road with your attorney, playing a longevity game, trying to burn out the other person's pocket, and kicking the can down the road while you're stuffing as much in, because you can pay these life insurance policies off within 5 to 7 years, depending on the lawsuit, depending on how it's going to go. But pretty much that's how you turn the frown upside down, and the guy gets to keep it, and he's like, oh my God, this is amazing. I'm super happy. I now have a baller life insurance policy for when I die. A $10 million premium would be probably like a $100 million policy, which you have to qualify for. There's health and all kinds of stuff that goes into it. You have to show proof of income and that you merit needing that kind of insurance policy. But like Bernie Madoff, this is what he did. He wasn't able to pay back the investors. Why? Because he knew he was pissing it down the drain, and then when he knew he was in trouble, pretty sure he probably did this. Most attorneys know what to do. So if you're an attorney, need help, give me a call. I know People's. If you want one of these, let me know. I got People's. If you're in this situation, I pray you're not, but shit happens. And if you make more than $250,000 and you want to implement some of these, click the link below and make sure you schedule a call with me and we can kind of go through this. And I've got people I can refer you to that will help you with all of this if I can't do it myself.